Good afternoon, grade 11 girls and boys. Welcome to your second accounting session. My name is Mrs Moyce, and I will be going through the financial statements of a partnership. I'm going to try and go through it very carefully because I know that some of you might not have done the financial statements of a partnership, but you certainly have done the financial statements of a sole trader. And what I'm going to do today is I'm going to show you the similarities between the two sets of financial statements, that of a sole trader and that of a partnership. And then I'm going to point out the only new items that you add to the financial statements of a partnership. So you'll see that the two are very, very similar except for two notes. You'll see when I explain the income statement that it's exactly the same as the income statement of a sole trader. So I don't want anyone to panic. I want you to sit, relax, and I want you to enjoy this lesson. I want to go to a PowerPoint first, where we're going to talk about the importance or what you should look out for in the income statement, what the purpose of the income statement is, and then what the purpose of the balance sheet is. Then I'm going to show you an income statement, and then we're going to start with an activity. So let's turn our attention to the PowerPoint. Financial statements of a partnership. Okay, there's the income statement and there's the balance sheet. Now you know these two terms from last year in grade 10 when you did a sole trader. So what is the purpose of an income statement? It is to determine the financial result of the business or of the partnership. Now, what is the financial result? The financial result is whether a profit or loss was made. Did this business make a profit in the financial year or a loss? And you'll find out this information by drawing up an income statement. Then, what is the purpose of the balance sheet? The purpose of the balance sheet is to determine the financial position of the business. In other words, it's equity in relation, it's assets in relation to its equity and liabilities. And remember, that's the accounting equation, but that is in essence the balance sheet. It looks at the assets of the business, the total assets, then its equity and liabilities. So it also looks at the business's net worth. Then, just to familiarize yourselves with the income statement of a partnership is exactly the same as the income statement of a sole trader. So let's look at the first part of the income statement. That's the top part of the income statement. There you have sales. Okay, so there you have sales. Now remember that sales there is sales less debtors allowances. So that's actually net sales. You take your debtors allowances away from sales and you put the total there. Then you have your cost of sales amount. Your cost of sales will always be in brackets. It's a negative amount. It's an expense. It has a negative effect on your income statement. So therefore, sales or net sales minus cost of sales gives you gross profit. Once you've determined your gross profit, you turn your attention to operating income. Now, I'm going to mention a few incomes that you can find under operating income. And these amounts or this information you'll find in the credit column of the nominal accounts section. So your incomes will be in the credit column of the nominal account section. So you can have rent income will be an income, discount received will be an income, bad debts recovered will be an income. What you will learn this year when you do adjustments, you'll learn a new income called provision for bad debts adjustment. When you decrease the provision, the difference or the adjustment is an income, but your teacher will show that to you at a later stage. You add your incomes together and put the total on top, okay? And then gross profit plus other operating income will give you gross operating income. That is the top part of the income statement. Then the bottom part of the income statement, remember on top of this I had gross operating income. Now I have operating expenses. I'm going to list all my expenses here. And how do you know what an income is and what an expense is? Firstly, you only extract information for the income statement from the nominal account section of your trial balance, of your pre-adjustment trial balance. So every item that's in the debit column of your nominal account section, except for my 2 on top here, except for debtors allowances and except for cost of sales, every item that's in the debit column of the nominal account section will go in this section. You add it together, and you please don't put this in brackets. You simply add them together and the total you will put in brackets. Then you will take your gross operating income from your previous slide. Let me show you again. Your gross operating income here from your previous slide. Okay, then you're going to subtract your operating expenses and you're going to find your operating profit. Now you're going to put in your interest income. So you never put interest income on the top by your incomes, and you never put interest expense by your operating income. These are not operational incomes and expenses. Okay, they are financing incomes and expenses. So you put your interest income here, interest on current account, interest on fixed deposit, you'll put here, and then you'll add the two together and you'll get profit before interest expense. You'll subtract your interest expense, interest on loan, interest on mortgage bond, interest on overdraft. You'll subtract there and you'll find your net profit. Now, if you remember your income statement from last year, you'll see that there is no difference at all. So girls and boys, that is the income statement of a partnership as well. There are only differences in the balance sheet, and there are minor differences. So my advice to you, if you use your income statement of your sole trader as a base, you just have to know where the differences are. So let me turn your attention to your differences. I just want to point out that we are on, what I've just shown you is on page 8 of your question book, not in your answer book, okay? It's on page 8 of your question book, and you'll find the format of your financial statements on page 8 and then page 9. So let's go to page 9 quickly. I just want to show you what is different, okay? So if you look at your equity section, I know I'm bouncing a bit, right? But I just want to show you what's different in your balance sheet. So it's only this. In fact, it's just one addition that's different. In your sole trader, there was only capital. Now in your partnership, you have capital and current accounts in your balance sheet. So let's go through the balance sheet. This is the face of the balance sheet. This is your format of your balance sheet. Okay, so I'm on page 9 of your question book. So please turn to page 9 of your question book. Let me just see if there are any questions. I don't see any questions yet. Okay, and no, there are no questions yet, girls and boys. I encourage you to ask questions so that I can answer your questions, so that I can see where your problems lie. But for now, sit back and just absorb what I am saying. Okay, so let's go to the balance sheet. Our balance sheet is made up of assets, okay? Remember our accounting equation? Assets, I'm going to put a big A there. So you'll see that this is actually the format of the accounting equation. So what do you have under assets? You have non-current assets, and these are long-term, more than a year. So this is long-term. In other words, what we mean by long-term, these are assets that we are going to have or keep or retain for more than a year. This is your fixed assets, fixed or tangible assets. Please note, it's at carrying value, okay? And then your financial assets, and your financial assets we also know as fixed deposit. So there we go. So if you want to know what your financial assets are, it is your fixed deposit. That is your 2 non-current assets. And what you're going to do is you're going to add this together and put the total on top. Okay, so that is how you're going to get your total for your non-current assets. Then, and this was taught to you last year, right? Then you have current assets. Okay, so your current assets are your inventories. Nothing new. Your inventories is really your trading stock. Okay, your trading stock taking balance plus your consumable stores on hand. That will be your 2 inventory items. So that is trading stock on hand as per the adjustment, and that is your unused stationery or consumable stores or packaging. That is that amount. You add the 2 together and put the total there. Trade and other receivables is generally a note, and I'm going to show you the note in a minute, okay? But trade and other receivables you see as debtors, okay? It's items or assets, current assets, items that's owed to you by outsiders. So these items are owed to you, like debtors control, accrued income, and those prepaid expense is technically owed to you, so that you categorize there. Then cash and cash equivalents is money, okay? Everything to do with money you'll put in there. There's also a note, but this is generally, seldom do that note. It's bank, petty cash, and cash float. Okay, that's generally those items. Now, that is only if bank is a debit balance. If bank is a credit balance, then bank will be under bank overdraft, which is lower down. So, only if bank is a debit balance. So, that's your assets, your current and your non-current assets. What you will do is you will add these 3 items together, okay, and you put the total there. Then you take non-current assets plus current assets, and that will equal your total assets. Okay, so that's how you add your 2 totals. Then I'm going to turn my attention very quickly to the equity and liabilities. Doesn't that remind you of the accounting equation? Assets must equal, okay, let's pull this down there. Assets, total assets, must equal equity plus liabilities. And that is how you remember the layout of your balance sheet. If you know that you categorize all your assets on top, and then you put your equity and your liabilities at the bottom, it will be easy for you to remember. Okay, so there I have my owner's equity, which is made up of capital and current accounts. Now, where I put the star, these are 2 new notes that I'm going to show you. There I have my non-current liabilities, non-current, more than a year, long-term, same as the top. Money that I loaned from a financial institution, okay? Sorry, that I borrowed from a financial institution for more than a year. So I'm going to owe them this in a long, long term. Then I'm going to have my trade and other payables, which is seen as creditors, okay? It's everything that I owe to someone. And that includes creditors control, that includes SARS pay as you earn, that includes income received in advance. It's all items that I owe money for that I put there. Can you see that that is my bank overdraft? If bank is a credit balance, I put it in there and not on top by current assets. And then my current portion of the loan, I will explain later on, but let me just explain to you. Current is short term, okay? Less than a year. So I am going to move, if I owe money in the next financial year that I'm going to pay back. So let's, for instance, say that my loan is 50,000. And of the 50,000, I'm going to pay back 10,000 next year. Then what I do in this situation, I put 40,000 there because 40,000 is still owed over the long term, and I put 10,000 here. I still owe 50,000 on my loan, but 40 plus 10 gives me 50. It's just I am moving it to a current portion to show that I owe this money in the short term. At the end of it, I'm going to add this together, okay, and put the total there. Then I'm simply going to copy that total and put it there, the same total, I'm going to put there, and then I'm going to add this together and put that amount there, okay. Now I add my totals, equity plus non-current liabilities plus current liabilities, and it's going to equal total equity and liabilities. And then when I check to see whether my balance sheet balances, my total equity and liabilities must equal my total assets, and hence the accounting equation, which is assets must equal equity plus liabilities. If you remember your balance sheet that way, you cannot go wrong. What you're going to have to do, girls and boys, you are going to have to study your format. Now, I know that your teachers tell you that all the time. Your teachers are continually saying to you, please study your formats. And I know, as an educator myself, sometimes our learners don't study, but I'm encouraging you to study because next year you are in matric. And let me tell you, income statement and balance sheet is a very, very important section of your matric work. Okay, so please take that seriously. Then, I just want to go through a few notes with you. I'm not going to do the notes with you, but I just want to point out some important notes that you need to know. So here you have your tangible or fixed assets note, right? Generally known as note number 3 in your financial statements. Now, note number 3, at the end of it, I am going to use this amount here, where I'm putting the asterisk. That is the only amount I'm going to use for my balance sheet. Okay, what is that amount made up of? It's made up of my cost price of my land and buildings, vehicles, and my equipment. Okay, there's my cost price. So this is the information at the end of the year. This is the information at the beginning of the year. And this is the movements. So what will make that amount change to that amount? I bought more land and buildings, vehicles, and equipment. I disposed of some land and buildings, vehicles, and equipment. And I depreciated vehicles and equipment. I don't depreciate land and buildings. And that changes my balance from that balance to that balance. But at the end of the day, this information is important. My cost price minus my accumulated depreciation gives me my carrying value. And that is the amount that I put on my balance sheet. Carrying value of my fixed assets goes on my balance sheet. What is that made up of? Cost price minus accumulated depreciation. Okay, let's look at the other note, trade and other receivables, also a very important note. There I have my trade debtors, and my trade debtors is debtors control, my debtors control balance that I use. Provision for bad debts, if you weren't taught that adjustment yet, okay, that is an adjustment. You minus your provision for bad debts to get your net trade debtors, which is debtors control minus provision for bad debts. Then I'm going to add, okay, so I'm going to that amount, I'm going to add my prepaid expenses or expenses prepaid, my income accrued or my income receivable, okay, and my deposit for water and electricity. Remember, that is refundable. The deposit that I paid is refundable, so technically the municipality owes me that. So those items I add together to my net trade debtors and I get my total, which also goes onto my balance sheet. So the totals at the bottom there will go into your balance sheet. Cash and cash equivalents, okay? Cash and cash equivalents, there we have it, right? My savings account, my bank, my cash float and my petty cash. So this is when it is a debit balance, when I have money in the bank. This amount here is the fixed deposit that will mature in the next 12 months. Okay? So let me just show you quickly. This amount here, fixed deposit, financial assets, this amount here is my long-term investment. In other words, the money that's tied up for more than a year. If some of this money is coming back in next year, the next financial year, I simply put it there. Okay. I move it from a non-current to a current. Let me just see if there are any questions. Okay. What does CSOH stand for? Yes, I know I shouldn't be using abbreviations, but I'll tell you what it stands for. CSOH, and please, girls and boys, don't use it. I just use it because I didn't have space. It's called consumable stores on hand, and it's an adjustment that you should have done last year. Okay, so if I bought 5,000 rands worth of stationery, and I have left over. Let's say I have 500 rands worth of stationery left over. Then I used 4,500 rands worth of stationery. That goes into the income statement, and that is consumable stores on hand, which goes into the balance sheet. Okay, and there I've explained that very, very quickly. Another question, it says, hi, this is Rochelle Buerta. Just wanted to ask if you could please give the website because you spoke too fast. I'm sorry, Rochelle, I didn't mention the website. So I'm not sure if it was the previous teacher that mentioned the website. Okay, so I'm hoping that you would be able to find these and play back these videos so that you can catch the website, but I don't know which website that was. I do apologize for that. Okay, so there we go. I've answered the question. What does CSOH stand for? Consumable stores on hand. So there we go, cash and cash equivalents. Another note. It's not very popular that they ask this note, but you have to know the note anyway. Then trade and other payables. Payables refer to creditors. Okay, I owe that to someone. So there you have your trade creditors, which is also known as creditors control. Okay. There you have your expenses payable or your accrued expenses, okay, whichever terminology you use. Income received in advance, that's a liability. Accrued expense is a liability. Then here, this is grade 10 work, pension fund, medical aid fund, SARS, PAYE. This is all amounts that is owed to the pension fund, to the medical aid, to SARS, and it's in the section that you were taught last year on wages and salaries. If you add all of that together, you simply add all of that together, and you put the total at the bottom, that goes into your balance sheet. Okay, and this is the new notes. Okay, so nothing that I showed you above was new. This is the new notes. There's your capital note. There's your current account note. Now, notice, there you have capital, partner A, partner B. Why? Because you have more than one owner. So you are going to have more, you're going to have to disclose more than one capital account. Okay, because there are two partners. So you simply write down partner A's information there as given, partner B, and they'll give you a name for those partners. When we do the activity in a minute, I'm going to show you, and you simply take in the total. So there's your balance at the beginning of the year. Contributions, that's additional capital. Okay, we our owners put in more capital during the year, and this is the withdrawals. In other words, not drawings, withdrawals of capital. If they took capital out, you minus it, and then that is your answer. Girls and boys, I am not going to do this note with you here. I'm actually going to do this note in activity 3. So what we're going to do now is we're going to do activity 3. So let me just escape there. And let me just go at the bottom. And there we go. On your screens, you should see activity 3. Okay. I'm just going to scroll down. It is found on page 12 of your question book. There we go. Page 12 of your question book. And we are going to do this activity. I'm actually going to do it with you step by step. Okay. Let me just see if there's more questions. I see a lot of questions are coming through quite late about the macro and the micro environment, which has got nothing to do with accounting. And thank you very much, Zandile, who says that they can hear me loud and clear. Thank you. Okay, so if you look at the activity, so this is what you should have in front of you. You should have the activity in front of you. Let's read. You are provided, I'm reading at the top here, you are provided with the information relating to Go Gold traders on the 28th of Feb 2017. Girls and boys, it's very important to establish year end. My year ends on the 28th of Feb 2017, which was yesterday. Okay, what do they want us to do? They want us to prepare the note for current accounts, and that is, you won't know this unless your teacher taught it to you already. Otherwise, you're going to listen up, and I'm going to do this note with you, and then prepare the balance sheet for 28 Feb. Okay, You are required not to show the work. You are required, when notes are not required, my apologies, show workings in brackets. And I can already say to you, only that note is required. So we are going to show a lot of calculations in brackets. Okay? Then, the following figures were extracted from the books on the 28th of Feb, the last day of the financial year. Okay, so there we go. Can you see? Do you remember I explained to you the capital account? Capital Goliath and Capital Goldworth. So there are two partners in this company. Goliath, who invested 900,000 in the business, and Goldworth, who invested 1,020,000 in the business. This is their capital investment. That's their drawings. Can you see? Each of them have a separate drawings account as well, and each of them have a separate capital account. But we are going to do the current account. So we're not going to look at capital now, but we're going to definitely look at current account. Okay, so here we find the balances for the current account, okay, and these are opening balances. Your current account balances are never closing balances. They're opening balances because we haven't drawn up these accounts yet. Okay, so we're going to put that in to your current account note. That is the only information we need for the current account note for now. The other information, I'm going to show you where to find it. Okay, so let's scroll down to the bottom of the page, the bottom of page 12. Okay, I hope you're finding it. You're there on the bottom of page 12. Okay, now the information I showed you on top, that is what we're going to need. We're also going to need this information here. Okay, that's very important. We're going to need the net profit. So I'm going to highlight that for you quickly. That is what we're definitely going to need. And then we're going to need all this information, the partnership agreement. Okay, so I'm going to highlight that as well. So that's the information we're going to need for our current account note. And we're going to need this information here. That's the only information we're going to need for now highlight text. So I'm going to keep the text on yellow and I'm going to work with it. Okay, so you know exactly what we need. So let's start. Right. The first thing we're going to need is the profit as per income statement. Now they've given that. They say that the profit as per income statement is 780,000. Okay, so let me just show you where that is. Right? I highlighted that amount there. So there, the income statement showed a net profit of 780,000. So I've got that. Now I'm going to read this information and fill in as we go along. Okay. Mr. Goliath earns an annual salary, that's a yearly salary, annual is yearly, of 180,000, while Goldworth earns 24,000 per month. Now, what's the difference here? That is annual, already 12 months. That is for 1 month. So I want to convert that into annual as well. So I'm going to say 24 times 12 so that I can bring it in line with my annual salary. Okay, so let's do that. The first item, it's salary of partners, so it's salaries. I'm going to put it in there. There, I'm going to put my salaries in there. Okay. Goliath earns 180,000. Okay. And Goldworth earns 24,000 Rand per month. Times that by 12, 288,000. Okay, if you're not sure where that came from, I took the 24,000 and I times it by 12 because I want to convert it to an annual because this statement is drawn up at the end of the year. So I need the annual amount. Okay, let's read the next line. The partners earn interest of 12% per annum. The capital balances have remained unchanged. So what the partners also earn, okay, they said I'm going a bit too fast, so I'm going to slow down. What the partners also earn is interest on their capital. Interest on their capital. So let me just quickly explain. In a partnership, partners are rewarded for investing more money in the partnership, okay? And the way they are rewarded is they earn interest on their capital investment. So you can see that 900,000 is what Goliath invested, so he earns 12% of that. But Goldworth, he invested 1,020,000, so he should earn more interest in rand value. They're earning the same percentage, but in rand value, the one is earning more than the other because he's being rewarded for investing money in the capital, in the business via his capital. So the next line we're going to put down is interest on capital. Okay, now we're going to take 12% of Goliath. Let's just show you here. 12% of what Goliath put in. Okay, Goliath put in 900,000, so 12% of 900,000, and that's right, it's 108,000. And 12% of 1,020,000, that is 122,400. Okay, I'm hoping that I slowed down a bit. I know some people say that I'm going too fast, and I would like to slow down so that you can understand the work. So let's put it in. Just remember, it's 12% of their capital, and their capital's unchanged. 108,000 and 122,400. Okay, you can see that I'm not adding anything yet, because I just want to get this done based on my information. Then let's just go back to the text quickly. Let's just go back to the text, and I'm following here at the bottom. It says, I'm going bullet point by bullet point, and I'm filling it in. Mr. Goliath earned a bonus of 25,000 rand. Okay, so let's put the bonus in. The next thing I'm going to put in is bonus to partner. And Goliath earns 25,000 rand as a bonus, and Goldworth does not get a bonus according to the information. And the last line item I'm going to put in, okay, is I'm going to work out my final share of the profits. But let's just talk about that quickly. Right. So, a partnership, or the partnership, the business earns 780,000 in net profit. Right? The net profit 780 is divided amongst the partners because there's two partners. If there was one sole trader, he would have received all the money, or she would have received all the money. But there's two owners, so the net profit must be distributed amongst the two owners. And it's distributed in the following way. It's distributed by way of salary, it's distributed by way of interest on capital, and then a bonus. Whatever remains after that, it says here, is divided equally. Okay, so let's just do that calculation quickly. What you have to do is you're going to have to add all your amounts. So now you're going to add these three amounts and put the amounts there. Same, you're going to add those two, and you're going to add across. Okay, now you don't have to add because I've got the answers here, and I'm going to write the answers down just for the sake of the exercise. That's 313, but you're going to add that together. That's 410,400, okay? And I'm only going to put in this amount, girls and boys, 723,400. Okay, for now, just for the sake of the explanation, because I don't want to put in too much information and you get confused. So, your next step, okay? Your next step. How do I get to that final distribution of profits? So, what we call this, these amounts here, okay? That is called the primary distribution. That's the primary distribution. The primary means first. You went to primary school first, and then you went to secondary education. So we call that the primary distribution, and then we call this the final distribution. Okay, in other words, what's left over after primary. So how do we work that out? We take our net profit, okay? We take our net profit and we subtract the primary distribution from it. So net profit minus primary distribution, that is going to give you the total final distribution, 56,600. 56,600. That amount is shared equally. That is what they're talking about in that last line. So I'm going to take 56,600 and I'm going to divide it by 2 because it's shared equally, and they each get 28,300 final distribution. And that I put in there, 28,300 28,300 goes in there, and that equals to 56,000. Now, when I add these two amounts together, okay, my primary and my final distribution, these two amounts here, my primary and my final, it should equal my net profit. So, if I add these two together, I'm going to get a total on top. Okay, so I'm going to put that total on top. So I'm going to say that amount, I'm going to take to the top there, and that is 341,300. Okay, that's that there, and then this amount, these two added together, going to add that together, and I'm going to put it on top there as well, 438,700, and you can actually audit. Sorry, you can actually audit. So now you can say, what is my audit? These two added together must equal to 780. And these two added together must equal to 780. So can you see why I didn't fill that in for now? Because I didn't want to create too much clutter here, so that you can see where the amounts come from. Okay, let me just see if there are any questions. Okay. I can't answer you that if there's any telematics, physical science, and mathematics, unfortunately. Okay, and I see a lot of people are still asking about business studies. We are busy with accounting. So I do apologize. The business studies class was earlier on. Okay, so let's continue. So now what I need to do is, now I need to finish up. Okay, now I need to finish up the bottom part. I got all that information. Now I need to finish up. So I need to now take off my drawings for the year. Okay, there's my drawings, and my drawings will be in brackets. So I'm going to show you how that works. My drawings, let's just go to our notes again. Now, I find my drawings there. Okay, so I'm going to need my drawings information as well. And I'm simply highlighting the information that I need for this note. Okay, so I need 450. They say Goliath withdrew 450 and gold was 391. So I'm going to write 450 under Goliath's column. And I'm going to write 391, 500 under Goldworth's column. Okay, I can add the two together, but I'm not going to do it now. There I have my retained income for the year, and that amount I get from my balance in my balances. So let's just go back to the notes again. There's my opening balances. Okay, 94,800 for Goliath and 73,500 for Goldworth. So I'm going to use those amounts, my balances at the beginning. Although it's reflected at the end of the year, this the note wasn't drawn up yet. So these are definitely my opening balances. 94,800 for Goliath and 73,500 for Goldworth. Now, these amounts can be debits or credits. Okay, I can see that these are credit balances because they are not negatives, but we can talk about that at some other point. Sorry, I put it in the wrong place. 94,800, my apologies, and 73,500. Now I'm going to have to scratch that out, unfortunately, because I put it in the wrong place. Okay, now all I'm going to do is do adding and subtracting. Okay, now all I must do is do adding and subtracting. So I'm going to take my blue. Oh, wait, let me take my green. Okay, so what I can show you, I'm going to show you the first line, how you work it out. You can see that Goliath earned 341,300 in this business, but he withdrew 450,000. So he took out more than he earned. This is what they earn. This is what they took. Okay, so he earned 341 and he took 450. So guess what? He took more than he earned. So now he's got a negative balance. And he took 108,700 too much. 108, I'm going to write it here because I made it 108,700. I made it very untidy there. Okay, he took too much. Goldworth earned 438,700 but only took 391,000. So therefore, he took 47,200 less than he earned. Okay, so you can see that that amount will be in brackets because he took too much. That amount will not be in brackets because he took less. Now I'm simply going to 108,700. Oh, I really messed this up here. Okay. Now I'm simply going to take that amount. It's a negative 108,700. And I'm going to add my balance at the beginning of the year to get my balance at the end of the year, 13,900. And that is what Goliath owes the business. Okay. He now has a debit balance. He took too much. Now I'm simply going to take that plus that, which gives me 120,700. It means that the business owes Goldworth that amount. He took too little. Okay, this is a very, very important note, girls and boys. And why would the company, you can do all your adding across, please. That's simply just to validate the amount. So please add all of that across. I'm not going to do it with you now because you needed to know how to calculate. Let me just go through this again. That plus that will give you that amount. How did I get that amount? I took my opening balance and I minused my drawings. Took my opening balance minus my drawings and it gave me that amount there. Okay. Sorry, my note is a bit untidy, but I'm hoping that you understand this note. Okay. This note is a very important note. Everything in your balance sheet is exactly the same. When I see you again in, I think it's going to be in next term, I'm going to continue with the balance sheet of a partnership. And then we are going to do the balance sheet itself. Okay, so let me show you what the balance sheet will look like. They will give you a blank balance sheet. Okay, I'm hoping that you're going to work together with me to complete the balance sheet. Okay, so let's see how much we can remember from our example. Okay, we had an example earlier on, so let's see how much we can remember. In this first line, I remember, and I'm hoping that you're working with me, girls and boys, fixed assets. Okay, and remember it's at carrying value, or book value. Another word for carrying value is book value. Okay, let me just see if there are any questions here. Someone's just saying good afternoon, ma'am, and I'm saying good afternoon to you. And yes, I know I can't give you a chance to calculate, unfortunately, because there's not going to be enough time. Okay, so yeah, I need to kind of, because I want to also finish the balance sheet. We literally have 10 minutes left, and I want to balance between going too slowly and going too fast. Okay, so I'll slow down a bit and give you some time to calculate. Okay, so fixed assets, there we go. Also, at carrying value, or another word is book value. Then, who remembers what we must also put in there is fixed deposit or financial assets. Okay, now we might not have a financial asset, but let's just see. But fixed assets and financial assets. Who remembers the three current assets? The three current assets, and I'm hoping that you're saying it in your class where you are now, and you must put it in this order. Inventories, which is trading stock and consumable stores on hand, trade and other receivables. So this is what I'll do if I must get a question like this. I will first fill in the blanks. Okay, I will literally first fill out all the blanks and then do my calculations. And then cash and cash equivalents. Okay, that's my cash. So there's my non-current assets. There's my current assets. I remembered that. Right. Now, let's look at our equity. Only two equities. It is capital, and current account. Capital and current account. Those are my two equity accounts. Okay. Non-current assets will be loan. Okay. And I might have a mortgage bond. What's the difference between a loan and a mortgage bond? A loan is from a financial institution to buy all sorts of things like, I don't know, assets. You can buy assets with loans, equipment and those sorts of things. A mortgage bond is to buy property. Okay. Then, current liabilities, I have trade and other. Payables. Okay, trade payables is creditors control. Other payables is things like income received in advance and accrued expense. Trade receivables is debtors control. Other receivables is things like prepaid expense and accrued income. Okay, that is what you must also remember. And then I can also have my short-term loan or my current portion of the loan. And I can have my bank overdraft if bank is a credit balance. Okay, so let's turn our attention to the screen and let's see what information we need. Right, so I'm done with my capital and my current accounts. So from mortgage bond onwards, now I'm simply going to work my way down the table, okay, and I'm going to complete this information. But remember, I took into consideration information number 1. I've done that. I haven't considered information number 2, so I must still consider that. And I've done information number 3. So number 2, I must just draw my attention to. Okay, so let's start. I'm going to start in this order from the top to the bottom. So I'm going to skip out on mortgage bond for now. I'm going to go to land and building. So there we go. I want fixed assets at carrying value. So how do I get my carrying value? I say land and buildings, which is that amount, okay, plus my equipment minus my accumulated depreciation. So I'm going to say that plus that minus that to get carrying value. Remember, carrying value is cost minus accumulated depreciation. Okay, I'm going to put my amount in brackets on top because I don't have space at the bottom. So it's 1,708,000 according to my information. Okay, and I'm going to plus my equipment balance, which is 584,000. And I'm going to minus my accumulated depreciation, which is 76,740. And that will give me carrying value, which is, I'm sorry, I'm not making you calculate, 2,216,060 rand. Okay, so there we go, 2,216,060 rand. That is my fixed assets at carrying value. I don't have financial assets, so that if I were to have financial assets, I would add and put it on the top, 2,216,060 rand. Okay, so there we go. Finish that. Inventories. Okay, so let's go back and let's see what we have with regards to inventories. There I have trading stock and there I have consumable stores on hand. Okay, so those two amounts, consumable stores on hand, there it is. Okay, and there's my trading stock. That is my inventory. So 427. Okay, there we go. 427,480 plus 22,140, and that gives me 449,620. Okay, so there we have that. Now I'm going to look at receivables, and if you can remember what receivables are, debtors control, accrued income, prepaid expense, and those sorts of items. So let's look to see where we find that. And there it is. There's debtors control, okay, minus my provision for bad debts to get my net trade debtors. So it's that amount minus provision for bad debts. And let's see. There I have accrued income. So I'm going to add my accrued income there. And there I have prepaid expense. So I'm going to add those two. Okay, because I know that those form part of debtors. Okay, you're going to have to study your notes. So let's start with that there. 61,640 minus my my provision for bad debts, 2,325. Okay, plus my accrued income, 11,580, plus my prepaid expense of 2,760, and that gives me an amount of 73,655. My cash and cash equivalents is, let's go to cash and cash equivalents. Bank is credit, so that's not, I'm not going to add that, but there, I have savings account, I have petty cash, and I have cash float. So I'm going to add those three together. Savings account, petty cash, and cash float. Why am I not adding bank? Because it's a credit balance. Okay, so I'm not going to add bank. So there we go. 60,000 in my savings account, plus 900 for petty cash, plus 600 for cash float, and that gives me 61,500. Okay. My capital, I'm simply going to add my two capital balances together that I have on my pre-adjustment trial balance. I'm simply going to add those two amounts together, 900,000, okay, those two there, 900,000 plus 1,020,000, okay, so I'm going to say 900,000 plus 1,020,000, and that gives me 1,920,000. And this amount I'm going to get from that note that I just completed now. Okay, this amount that I just put a star next to, I'm going to get from this note. And where do I get the information from? Okay, let's see if I can make a curly bracket there. Oh, it's a bad curly bracket. I'm going to add that together. These two I'm going to add together. And that is the amount that I'm going to put in my balance sheet. So that's a negative. So I'm going to say minus 13,900 plus that amount. Okay? And that gives me 106,800. And that same amount I'm going to put into my current account note. So that's where I get that from. That's why I've got the note, so that I can put it in here. 106,800. Girls and boys, I'm going to have to finish up. But before I finish up, I just want to show you this one thing quickly. Just one thing. It's going to take me 1 minute. I just want to talk about the loan, okay, and that number 2 there. So there I have a loan, 108,000, and there I have mortgage bond, 480,000, okay? So that is the amount that I owe to these two institutions, mortgage bond Worthy Bank and loan XY Bank. But look at the bottom here. It says 20% of the loan from XY Bank is repayable next year. Okay, so let me just do that quickly with you. My loan, XY Bank, okay, my loan is actually 108,000. My mortgage bond is 480,000. Okay, but I'm going to repay 20% of that amount in next year. In other words, 21,600 is going to be repaid next year. That amount I take away, okay, and I put 86,400, okay, as a long-term loan. Then I move that amount down, 21,600, to a short-term loan. And I categorize it as a short-term loan. Girls and boys, I have to finish now. If you can, please finish the rest, okay? You're going to add and subtract. You're going to finish trade and other payables, and you're going to put bank overdraft in there. And then you're going to balance your balance sheet. I'm going to try my very best to complete this activity when I see you next, because I do believe that it's important that you know how to finish a balance sheet. I'm currently teaching my matric learners how to complete a balance sheet without notes. So it's a really, really important skill. My advice to you again, study your formats. And that I'm going to say in closing, thank you for staying until 5 o'clock. It's only going to stand you in good stead. Thank you very much. Bye-bye.